All signs are now pointing towards an imminent housing market collapse, in which we could see everything start to break in the coming months. The market is in such a bad state right now that we are seeing the largest institutional home buyers halt making any more home purchases and begin to pull out of the market completely, flocking to assets that provide a more attractive yield. With prices sky high and demand falling off a cliff, we are on the brink of a complete implosion of the housing market. So the largest landlords in America, including big Wall Street home buyers, simply cannot justify buying houses in the current market and are scaling back their buying of single-family homes in the US, and in some cases even becoming net sellers. You see, these largest institutional investors are looking to get a premium on their rental property yields compared to a US Treasury bond yield, which is essentially the risk-free return. Now, the current yield on a 10-year US Treasury is about 4.8%, a yield that has been growing rapidly and is far higher than it was a few years ago. These Wall Street home buyers are therefore looking to get a larger rental yield on any new home that they buy on the market today, and yields on rental properties are just not competitive enough right now to compete with simply owning US Treasuries, especially when you consider the extra effort as well as the extra risk that is associated with buying and renting out property, plus the fact that there are currently very few deals coming onto the market. Right now, rental yields across various regions of the US tend to average around 6%, which is barely beating what you could get in Treasuries right now. And according to data from John Burns Research and Consulting, the portion of US home purchases that were made by large landlords, defined as owning more than 1,000 homes, has declined once again for the second quarter of 2023. These large landlords bought just 0.4% of US homes, which marks the fourth consecutive quarter of declining share and is now down significantly compared to the peak of 2.4% at the end of 2021. Invitation Homes, for example, the largest owner of US single-family homes, have recently been net sellers in the housing market despite their large buying spree in 2021 and 2022. The Real Estate Investment Trust sold off 675 homes in the first half of 2023, but only acquired 470 new homes, shrinking their total portfolio size to 82,837. And similarly to this, American Homes for Rent, another real estate investment trust giant, is also a net seller of homes in 2023, buying just 781 new homes, while at the same time selling off 1,081 homes. Both Invitation Homes and American Homes for Rent are both publicly traded real estate investment trust stocks, and looking at the performance of the REIT sector on the stock market, there are numerous warning signs flashing. Now, shares of many REITs, including the largest residential real estate players, have declined by multi-double-digit percentages from their peaks back in 2021 and 2022, and some single-family housing REITs even trade at a 20% discount to their gross asset value, according to Cedric Lachance, Green Street's Director of Research. Now, this is a clear sign of falling investor confidence in these companies and in the asset class in general, and also signals clearly the direction that investors believe that these property portfolios are heading in the future. The reason why these institutional investors are so scared of buying homes right now is because so many metrics are so out of line compared to historical norms that the market is absolutely broken and something has got to give soon to avoid a crisis. Now, for starters, housing affordability has not been this poor since the 1980s, in which new home buyers have to sacrifice an enormous percentage of their income on average for an average price home. So mortgage rates skyrocketing is partially to blame for this, and we're now seeing 30-year fixed rate mortgage rates at 7.5%, significantly higher than the peak that we saw during the global financial crisis, and in fact you'd have to go back to the year 2000 to find rates that were this high. House prices, however, have not corrected downwards to reflect these higher mortgage rates and have remained very stubborn. Looking at the most recent Redfin data, median home sale prices are barely down from the all-time highs that we saw in summer of 2022 and are in fact up 2.9% year over year, now at $370,900. Now, this combination of high home prices and astronomical mortgage rates means that the average home buyer housing payments have surged to $2,710. Now, this is close to $500 more per month compared to at the start of 2023 and approaching double the amount that it was in 2020. So average housing payments almost doubling in just 3 years is unprecedented and shows just how broken the market is as of today. This is especially the case when you consider that this is close to 40% of the average person's income for an average price home, according to this national payment to income ratio. And this means that homeowners are now having to spend a higher percentage of their income on housing payments than at the peak of the global financial crisis, another very scary indicator of the state of today's housing market. So with Wall Street and other institutional home buyers slowing down their buy-in or exiting the market altogether, this is forming a large dent in the national demand for homes, and the demand from these investors will not return until mortgage rates come down and/or home prices do fall significantly. This slowdown in institutional investment into the housing market due to market conditions could, however, be very bad news for the millions of US citizens who rent, as we could be about to witness a sharp hike in average rent. Now, this is because the cost of home ownership has increased at a much faster rate than the cost of renting, thanks to the combination of both surging home prices and mortgage rates, and there is now a large divergence between the two. So since the start of 2020, average monthly rents have increased from approximately $1,600 to $2,011, which is a growth of around 25.7%. Comparatively, in the same time period, average monthly homebuyer housing payments have increased from approximately $1,580 to now being $2,710, an eye-watering 71.5% increase. So because renting is now comparatively much more affordable than home ownership, this leaves plenty of room for landlords to increase their rental demands in the coming years to push the cost of renting more in line with the cost of owning. There's not really much tenants can do about this, as it will take many rent hikes to get to a point where they would be paying less on a mortgage payment on a similar sized property, while home prices and mortgage rates remain at these levels. As rent hikes start to pick up pace, this will squeeze renters for more money every month and leave them with less money every month to save towards a house deposit if they wish to eventually get onto the property ladder themselves. And until something changes with home prices and mortgage rates, we could therefore see home demand continue to dwindle in the coming years as more people get trapped renting and less people can afford to get onto the property ladder. And yields on many other types of assets could be about to get even better in the future, ultimately making homes far less competitive when it comes to attracting investor capital. Many prominent Wall Street figures have warned that a 7% base interest rate is still a very possible scenario due to persistent stagflation, and this includes the likes of JP Morgan CEO Jamie Dimon. With 10-year treasuries now yielding around 4.8% and 30-year treasuries yielding close to 5% after a recent surge, the rate of return that is now essentially risk-free is already much higher compared to a few months ago. So interest rates jumping to 7% from the current rate of 5.25% would only raise bond yields even higher and make investing in homes even less attractive. And that would be far from the only trouble that we would see in the housing market if interest rates did indeed reach 7%, as that would put mortgage rates even higher, and therefore housing affordability and mortgage demand would become even worse. There are also many dividend stocks that are also down significantly from where they were not long ago, now offering a much more attractive yield for investors and a solid alternative income generating asset to real estate. It's therefore hard to picture how the demand for homes from institutional investors reverses anytime soon when treasury yields are so high and are likely to remain at elevated levels for the foreseeable future, and also dividend stocks are becoming more attractive and taking capital away potentially from home purchases. So the housing market is undoubtedly in trouble, but we could be about to witness economic collapse on a much more wider scale, with JP Morgan and other large Wall Street players issuing terrifying warnings about the unthinkable happening. I covered this in full detail in my previous video, which you can check out on screen right now. And aside from that, please leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot, and thanks a lot for watching.